Welcome to the complete series recap for PNJ Group's ASC 710, Compensation General Training. This video brings together the key principles, rules, and practical applications from all 7 sections. The framework, accrual rules, measurement, deferred compensation, journal entries, financial reporting, and audit readiness. Use this as your refresher before a close or an engagement. ASC 710 is the general compensation standard that fills the gaps left by more specific standards. It covers 2 areas: compensated absences and deferred compensation. The core principle is matching. Expense the compensation in the period the employee earns it, not when cash goes out. Know the landscape. Pensions use a SC 715. Stock compensation uses a SC 718, and restructuring terminations use a SC 420. The 4 criteria test is the engine of a SC 710. All 4 must pass. Criterion 1, the benefit is earned by past service. Criterion 2, it either vests or accumulates. This is the one that fails most often. Criterion 3, payment is probable. Criterion 4, the amount can be reasonably estimated. Apply the test separately to every absence policy type. Vacation almost always accrues. Sick leave usually does not. Vacation typically satisfies Criterion 2 because it either accumulates across years or is paid out at termination. Use it or lose it vacation that neither accumulates nor vests is the exception, no accrual required. Sick leave fails Criterion 2 in most cases. Unused sick days are forfeited at year-end and not paid out at departure. But if the policy pays out unused sick days or allows conversion to vacation, all 4 criteria may then be met. Once you have determined an accrual is required, measure the liability at the amount you expect to pay when the time is actually taken, the expected future pay rate, not today's rate. Include employer payroll taxes and any benefits that continue during the absence. Then reduce for expected forfeitures based on actual historical patterns. These 4 components together give you the accurate liability balance. Sabbatical leave has its own rule. If the sabbatical is purely for the employee's rest and recuperation, no work required, accrue the cost over the qualifying years of service. If the employer benefits through the employee's sabbatical activities, research, reporting, do not accrue. Recognize the cost during the sabbatical period itself. The test is simple: who benefits from the arrangement? Termination benefit timing depends on who acts. For voluntary early retirement offers, recognize the liability when the employee accepts, not when the offer is announced. For involuntary restructurings under a SC 420, recognize when the plan is communicated to employees with sufficient detail. Board approval, internal memos, and management discussions do not satisfy the communication requirement. This is one of the most frequently cited audit findings in the compensation area. Deferred compensation is accrued over the employee's service period. Rabbi trusts hold the funding assets, but because creditors can still access those assets, they never leave the employer's balance sheet. Both the trust assets and the deferred compensation liability appear separately gross. No offset is permitted, and when the employer deposits cash into the trust, that is a transformation of one asset into another. The liability is untouched until the benefit is actually paid to the employee. 4 entries to have cold. Vacation accrual, debit expense, credit liability. Vacation used, debit liability, credit wages payable, no new expense because the cost was already recognized. Deferred compensation accrual, debit expense, credit liability, each service period. Trust funding, debit rabbi trust assets, credit cash, the liability does not move. These 4 entries cover the majority of a SC 710 transactions you will encounter in any engagement. On the balance sheet, current vacation liabilities sit in current liabilities. The deferred compensation liability is non-current. Rabbi trust assets are non-current assets on a separate line, never netted against the liability. On the income statement, vacation expense flows through salaries and wages. On the cash flow statement, changes in accrued compensation are operating. Cash termination payments are operating. But cash funded to the rabbi trust is an investing outflow because it represents an asset acquisition. Disclosures are not optional. For compensated absences, disclose the accounting policy and the material balance. For deferred compensation, describe the nature and terms. For rabbi trusts specifically, always disclose that the trust exists, what it holds, and that the assets remain subject to creditor claims. This is a fact readers need to understand before interpreting the balance sheet. The most practically important difference between U.S. GAAP and IFRS under this standard is in restructuring recognition. IFRS, IAS 37, recognizes a constructive obligation when a formal plan combined with employee expectations creates an obligation. This can happen before the specific employee communication required by ASC 420. When converting an IFRS entity to U.S. GAAP, always check whether the communication threshold was met before the IFRS liability was recognized. If it was not, reverse it for GAAP. The 6 common mistakes are worth memorizing. First, not accruing vacation at all, a cash basis holdover. Second, accruing sick leave when the 4 criteria are not met. Third, measuring the vacation liability at current pay rates when a raise is coming. Fourth, booking a restructuring liability before the plan reaches employees. Mistake 5, presenting rabbi trust assets net against the deferred compensation liability. No offset is permitted, both lines must be visible. Mistake 6, failing to clear a terminated employee's vacation balance when they leave. The balance sits in the accounts, overstating liabilities and distorting the accrual. Fix. Establish a same-day notification process from HR to accounting on every departure. The controls framework places clear accountability at each level. Team members record and flag. Team leads review and escalate. Managers approve and sign off. No judgment-based conclusion stays at the team member level. And for audits, the documentation auditors want most is the 4 criteria analysis for each absence policy, the employee-level vacation listing tied to HR, and the evidence of employee communication for any restructuring. Your 3-area period-end checklist: vacation and compensated absences, update from HR, apply the expected future pay rate, include payroll taxes, apply forfeitures, and verify terminated employees are cleared. Termination benefits: confirm all 4 ASC 420 conditions before recognizing restructuring liabilities, and confirm acceptance, not announcement, for voluntary offers. Deferred compensation: accrue for the current service period, confirm trust assets are on the balance sheet, and remeasure to fair value. 5 principles to carry from this entire series. First, match the expense to the period of service. That is the foundation of every rule in ASC 710. Second, the 4 criteria test applies separately to every policy, and criterion 2 is the most common point of failure. Third, rabbi trust assets are always presented gross on the balance sheet. Fourth, restructuring liabilities require employee communication before recognition. Fifth, documentation is not an afterthought. Your judgment is only as defensible as the paper trail behind it. Thank you for completing the full ASC 710 Compensation General Training Series. Thank you for watching. Subscribe for more training from PNJ Group.